Hi, I'm Professor David, here to talk about Canadian federal income tax and in particular the lifelong learning plan. The idea of a lifelong learning plan is for a mature person, usually someone maybe in their 20s or 30s, and the general place this works the most often is if you're going to pursue a master's degree or a second degree. So you have your regular person, they go through, they get their undergraduate degree, they go out, they work for a while, they contribute a bunch of money to the RSP, and they say, you know what, I really think I want to pursue a different undergraduate degree, or you know what, I really want to pursue a master's degree in the same field. And they've, say, put $20, $30, $40, $50,000 into their RSP, and now they want to stop working for a while, and they want to take that money out. So basically what happens in the lifelong learning plan, you're allowed to take out $20,000 over 4 years and up to $10,000 in any 1 year. And that money is basically the same thing as a home buyer's plan. It's not taxed when it's withdrawn, as long as it's paid to a particular financial institution. You've got, sorry, not a financial, a qualifying educational institution like a university or college. Anybody can qualify, but you have to be enrolled in full-time enrollment. It can't be part-time enrollment in a qualified educational program in the year in which you take it out. And that would be that you basically get a slip from the educational institution that says you're enrolled full-time, and then you'd submit that slip along with the rest of your tax documents when you submit your tax return. Now, paying it back, okay? When you go to pay it back, you have to start paying it back within 6 years of taking it out, which is reasonable because assuming the average program takes 4 years for undergraduate, 2 years for a graduate program, then 6 years is a reasonable time limit. You have to pay it back within 10 years on a straight line basis, and basically the formula works the same way as the home buyer's plan, 1/10, 1/9, 1/8, so forth. And if you don't pay it back, it gets added to your taxable income, just like they do with the home buyer's plan. Now, the nice part about the lifelong learning plan is you can take it more than once, whereas the home buyer's plan, you're limited to once every 4 years. Realistically, you've probably got about the same limit with the lifelong learning plan, and you have to live in Canada in order to take the home buyer's plan. There's a couple of rules associated with both the home buyer's plan and the lifetime learning plan with respect to residency. If you leave Canada permanently, I don't mean go for a vacation or go for a work assignment, then you have to repay it by the earlier of the filing date in the year of departure or 60 days after becoming a non-resident. So basically speaking, if you've got money owing to a home buyer's plan or you've got money owing to a lifelong learning plan, then you need to be and stay a resident of Canada while you owe the money back. Let's assume you die. Okay, boom, you're dead. Well, and if there's money owing, then clearly that money is then added to the value of your estate as income in the year of death. So be specific. Let's say you've got a home buyer's plan and you took it out for 25 grand, and at the end of the point in time in which you die, there's 10 grand still owing on the home buyer's plan. What happens is the 10 grand gets added to the taxable income in the year of death for the particular individual when they died, and they have to pay, the estate then has to pay tax on the $10,000 at the marginal rate of tax for the person that passed away. However, if you're married, your spouse can elect to take over the repayment schedule, and then there's no deemed disposition on death.